You never want to buy with the prediction that something's going to hopefully change. It's no different than buying an investment property going, this will work only if we get 10% appreciation next year. If that doesn't happen, I'm gonna roll the dice on this. You're gambling. It's a total gamble. We don't know. Welcome back to Life at 1010s, where we inspire you to live at the pinnacle of your ability and purpose. I've got Matt Bonelli with me today. As always, my name is Garrett Fry, and we are super excited to dive into this episode. We came across this topic, and both Matt and I were like, oh my goodness, this is what we're going to be discussing today, which is the saying that came up a long time ago. It really is a long time ago, but when it came up, I was like, oh my gosh, be so careful. Please don't dig a hole for yourself. Please don't make your clients go, you sold me on what? Matt, Marry the House, Date the Rate came out, and you went back and looked up the timelines on this. You were like, how long ago was that? And this was where we're like, we have to talk about this because this was an episode we did a long time ago.
We did this with our prior podcast, and like, I was going back, I'm like, well, maybe this was sometime last year. It was over 2 years ago that we released an episode about this after months of people saying this. Really,
we got flack when we released that episode.
Oh yeah.
I had people in my world that were like, I think that was totally inappropriate that you guys put that out because this is the hope people need to have so they can move forward. I had direct people reach out and tell me it was not the right episode.
People who we work with saying, no, I don't agree with you. This is what people need to hear so that we can still get people into homes. And I will say, since then, I've seen more people date the damn house than they have dated the rate. So like, so to give a little context and history to this, Garrett, too. So in early 2022, right, rates, when we rolled into 2022, rates were still in the very, very low threes. People were happy. This is great. Easy money, basically free money. And then within a matter of 5 months, rates went all the way up into the mid fives. And so people started saying this, hey, just marry the house and date the rate. Because you had all of these economists, quote, talking about the projections and like, don't worry, like rates aren't going to go that high. They're not going to stay up that high that long. Every year towards the end of the year, we heard people saying rates are going to settle next summer into this or that. And so people started saying this, hey, marry the house, date the rate, as a way to encourage people, like,
When it came out, Matt, I was like, wait, what am I hearing? Marry the house. And I kept hearing the word rate and I wasn't hearing it right. I'm like, what are you saying? This doesn't, I'm not hearing this right. I'm like, I need clarification. And I was like, oh, date the rate. Got it. Okay. Keep going, Matt.
Well, what's crazy about it too is like, on the surface, that just seems like really bad financial advice, no matter what it is. And I will give credit. There are a lot of people who are saying, hey,
don't worry, it'll appreciate.
Don't overextend yourself on your payment, though. Don't assume that rates are going to come down. Just know that, like, hey, this doesn't have to be forever, right? And it literally is the implication. This rate doesn't have to be forever. Well, a lot of people are going, is this forever? Because I bought my house at like a 5, which is actually a great rate because today, as the time of this recording, we're sitting at the very high 6s, some places 7% interest rates based on a 30-year fixed.
Yep.
But when that conversation started, Garrett, what's so funny is we released that podcast in August of 2022, and we have not even seen a 5 handle in front of a rate since that podcast.
Unless people were buying it down, I have not seen it happen.
Well, and all those two for one buy downs, one buy downs, those are all expiring now, right? So all the people who did that stuff, like their payments this year and into next year are going up without the foresight or the vision to be like, well, can I refinance it to a lower rate? It's like, no, you can't. Your payment's going up, and that's the deal.
When I heard that start to happen, what my brain said was, your job as a real estate agent is not predicting the financial future of what might be happening out here inside the banks. That we are overstepping boundaries. We are setting expectations that we have no control over. And the amount of times that I have watched people be wrong in predicting the rates is astronomically higher than being correct. And when we went through the time of the lowest interest rates we've ever seen, I was watching agents, and I myself, I will take full credit for this, was saying, we don't know how long these rates are going to stay this low. Like, this is an amazing time to buy because they could come up anytime now. Next week, we could see higher rates. Lock in now while it's so low. And it stayed low for, felt like
long
ever.
time.
I kept looking at it and going like, I'm stopping talking about it because it's not coming up. We could be at a 3% rate for the end of time as far as I'm concerned. And all of a sudden it kicked up. And that's where this thing started to come into, hey, you know what? Don't worry about it right now. It's going to come back down. And I kept saying, we've been so wrong about it coming up for so long. Do not predict it coming down. Like, that would be the worst thing you can do. And it was this overwhelming thing. We saw it on social media. I had people that I coached that were like, this is what I'm telling my people. And I kept saying, be very, very, very careful. Because what you're going to have happen is you're going to have people in about a year, 2 years, maybe 3 years out going, you told me that if I did this and I dated this rate and just went like, I fell in love with my house, but I am dating this rate. They have this dog of a rate still, at least in their mind. As you said, Matt, it's a good rate. Like, all these rates are still good rates.
If you got a 5 handle in front of your rate, like that's great right now.
It's a great rate. And rates are funny because, like, when you look at generations around us, we all have different experiences of what we've bought homes in. Worst rate I've ever bought in my time of owning homes was a 7% rate. And we celebrated it. We were so excited back in, I think it was 2001, 2002, when I bought my first home, that I was like, 7% rate. This is amazing. Like, we're doing this. And I look now and I'm like, in my mind, anything below a 7, I'm like, doable. I can see how it works. I can understand how it works. It's got, now if it were to go above 7%, all of a sudden I start sweating. And then I'm like, wait, what? Wait, why are we, is this the right time? We have a huge generation right now that got very comfortable with a 3% rate. And I think it's the smarter conversation to have with people, Matt, is that let's look at what these rates are. Like, it's not detrimental when it's 5. It's not detrimental, by the way, when it's 6. You just need to buy a little bit different house potentially in these marketplaces, but you never want to buy with the prediction that something's going to hopefully change. It's no different than buying an investment property going, this will work only if we get 10% appreciation next year. Because if that doesn't happen, I mean, I'm gonna roll the dice on this. You're gambling. It's a total gamble. We don't know.
Well, this is my frustration with our industry, is that for the most part, we don't educate ourselves deeper than kind of surface level topics. Like, if you think of marry the house, date the rate, its intentions are good. We're trying to focus on, hey, let's get you into this home that you really love. It's going to enhance your life and all of these things, which is wonderful. But the rate is one component to an entire financial equation for people when it comes to their home. And just talking about a primary residence here, because most people buy based on their monthly payment.
100%. That's what they qualify as.
That's how you get approved, right? Yeah, exactly. That's how you get qualified. So the rate is just a factor in that. And when you look at history too, because, okay, the rate's one thing, then down payment's going to be another thing. The price of the home's going to be another thing. So let's look at those home prices as well. And now from 2002, the median home price hasn't grown significantly than it did the years before between then and now. So, 413 to 420, which isn't anything crazy. So you look at the rate changes, but when we go from where it was 3 in the low 3s, 2020, right? 317, it was the low 3s for the home prices too, which went up into the low 4s. And so you also had this rate adjustment with an increase in home prices without an increase in average wages. And all that stuff factors in. And we got to be thinking about this as realtors out there. As we're guiding people, we should really be understanding our people. And these are hard conversations to have. And we're like, we yield to the lenders and love the lenders. And they show up and they do the numbers and they talk about what's qualified. And I'd say there's even some work to do there. But as a realtor, we shouldn't just say like, oh, well, I'm just going to leave the financial stuff up to somebody else and not have any understanding of this at all, because if you understand just how the money works, you're going to be able to give better advice and avoid these phrases like marry the house, date the rate, which I don't think anybody who did that. I mean, I am concerned, Garrett, for the people who did all the 2-1 buy downs that are coming due. And, they're like, they went through the first year. Gosh, payment got a little bit larger. Okay, now payment's a little bit larger. Next year, the payment's going to be a little bit larger. It's like, and then that's going to be your long-term payment because you don't have the ability to refinance because the rates haven't come back. The rates are higher probably than what you bought the 2-1 buy down on.
And anybody right now who's sitting here and saying, okay, we're going to see rates come down, or they're listening to predictions, right now, rates actually should be lower. From the predictions that I saw 3, 4, 5 months ago, right now, they're like, oh, and I saw graphs of people that I really do trust. Like, I trust their opinions. I trust where they're coming from. They're much more wise than me and educated than me when it comes into these areas. That I looked at it and it was like, oh yeah, if I took that graph, they're like, you can make this a postcard. Show your people, this is the prediction of rates. And I always keep going, do not share that. Like, that is not when you're predicting the future out and you're helping people make decisions based on a prediction that you don't really even understand and you don't know why and how that might trend out. Remember, you got to answer to that at some point in time. Whatever you put out, you are going to need to answer to, and you better be prepared to answer it. If I had to answer the marry the house, date the rate right now, I would be sitting there with my foot in my mouth going, it just kind of happened this way. I don't know. What is my deep understanding about why I said that to you? So I think, like, with the situation that we're in right now, Matt, is that we actually need to look at this marketplace and go, okay, well, why are people buying and selling? Let's focus on the changes in their life and the obstacles that they're trying to maneuver through. And we need to get it out of our mind that people buy and sell homes just based on a rate. They buy and sell homes because they need to buy and sell homes. And I know what I was thinking when you were talking about the people qualify based on payment. I got a flashback to when I used to sell cars, and anybody who has walked into a car dealership and they like a car, you go sit down with the salesman. This has changed a little bit, by the way.
If you bought a grid, right? You do the grid and you never even show the interest rate, right?
Number one question, what payment do you want to be at? And people are like, well, I want to know what I want to sell the car. Like, what do you guys want to sell the car for? The reason the salesperson starts there is they just go, they do the grid. Here's the payment you want to be at. We've got the trade-in factor. We got your down payment, and we got the sales price of the car goes in these other 3 categories. They can go and take all those factors and numbers, and because there's enough moving parts there to work it so that that number will come out in a place that will work. There's a lot to this actually in the home sales side too, is that you qualify for this payment is what you go in for. And they say you qualify for this much home, this price of home. Go out and do your search with your realtor, go out in the marketplace and run with that. But there are a lot of factors there of how much money do you want to put down? We've got all these other factors of concessions and different things of what somebody might be able to offer as you go through a transaction. You've got maybe we can get into all the factors of it. There's so many ways that place can come to be of what you need to have it at, rather than it just being this one simple rate that's going to get you there. And I have watched a lot of people, Matt, that have had to make the decision of, I can't buy the exact house that I wanted. We had to buy in a different neighborhood. We had to take away some of the amenities that we were really hoping at having. They still bought a home and they had it at the payment that they qualified for, and they're still happy and they're moving forward instead of burying themselves and going, don't worry, this is just short term. We'll be okay. And that's the danger side. That's the danger side.
It is. And, and I think it's not that you should ignore when people make predictions, like use them as conversational pieces to, like, instead of saying, because I think that's the problem, Garrett. A lot of people will take prediction and be like, oh, this is what's going to happen. Right. And, now that I'm kind of like having trouble with my timeline here, because I thought we did that episode last year, there were the predictions.
It was so great when you realized it was 2 years ago. The look on your face.
I was like, whoa, it's been that long. There was, at the end of the year, you always get like the big projections, right? From NAR, Mortgage Bankers Association, Freddie Mac, all the people, right? And I remember going into the new year, I think it was going into this year, maybe it was going into last year. They were like, oh, mid fives by summer, right? It's like, well, nope, that didn't happen. And like everybody just adjusts their predictions every quarter. And so if you take the predictions as like that is going to definitely be what happens, you could miss out on an opportunity as well. This is the other thing. When you start telling people these things, maybe they're ready to go now. And they're like, well, maybe I'm going to wait actually. And then the problem is the movement in rate, because the one thing that you don't really get back, like if prices move up, you can adjust things in your own personal world to help you with your monthly payment, but you can't go and change the pricing of homes, right? And even though it is kind of like predictive when people look at supply and demand and say, hey, here's where I think home prices are going, it's a lot easier to use metrics like supply and demand to help kind of indicate here's the direction that home prices are moving currently.
Yep.
Right. And until something changes, we probably won't see that trend adjust. Something could change tomorrow, right? Something could happen that all of a sudden blows up inventory or really significantly decreases demand. But for the most part, it's like this is the trend. And so you can't stop that, but you can work things on your personal end to help your finances work for you. And as a realtor and as a guide, a trusted advisor, these are the conversations we should be having with our homeowners and our buyers and our sellers so that they can get their act together. Because I think you get a lot of people, Garrett, who just sit around and wait, well, something will happen that'll allow me to buy a house. That responsibility is on you.
And I think, Matt, it's interesting as you look at like the long-term ownership of a house. Like when you buy into a house, you ride through this wave. I have been a homeowner literally, except for a small break. There was a moment in time that I sold a house. We were renters for about a year, and then we got back into owning a home again. And so you look at this wave. So that's really been about since 2004 to right now. So I got 20 years of being a solid homeowner of either one or multiple homes. My money's kind of rolling through this wave. It comes up with appreciation. It kind of goes down. If there's ever a hit in the marketplace, which I have been through, I have bought homes and they've been worth 60% less the next year from when I bought it. That was back in 2008. Then we ride through, and then all of a sudden the prices come back up. We ride through different rates. When good rates come about, we go, oh, look, great rates. And we refinance some of our stuff. We bring it down a little bit. And then there's a place where you turn over these homes. And hopefully we're going to get a good rate when we turn it over. But the minute that you are looking at, especially your primary residence, as an investment tool, I'm going to get it at this, this great appreciation that's going to come up next year. So I'm going to buy this now and do this. When you are buying specifically with an interest rate in mind of why you're buying your primary residence, like this is where it gets messy, because really as your primary residence, and this is my opinion, if people have different opinions on this, write in the comments below, please. Like I am open to having a discussion about this. But your primary residence, you are riding with the market. I will always be a homeowner. I'm not going to not be a homeowner. I've seen people go, oh, this change in marketplace coming up. The right thing now is to sell all of your real estate, rent, and then when prices drop, throw it all back in and buy it. I'm not going to do it with my primary residence. I could do it with some of my investments maybe, but then I've got to figure out how long can I pull that money out before I pay taxes on it, and how am I going to re-get that money back into the marketplace? You know what? Let them sit. I don't want to mess with that. Let them be there and hang out. And what is when it drops, I'll buy another rental. I'll increase my rental inventory, not play with those guys over there. And I think that we've got to be careful. Back in, coming out of the downturn, 2000, I was back in real estate back in 2005, 2006. We changed the look sometimes of our primary residence into an investment tool. And I remember one of my great mentors was saying back then, like, we've got to eliminate the word investment in our primary residence, and talking to our people about this is how your investment's doing. Primary residence is not an investment. You will make money out of it potentially, and it will work for you potentially. But really what it is you having control over a chunk of money and the house and the roof over your head and having the security of a place for your family. It's what it is.
That's a great point.
So we got to be careful about. I know I just kind of went on I kicked my soapbox away. There you go.
No, you and I are obviously on the same page on this one. I mean, a home, even if it's fully paid off, great asset to park money, but it's not making you money. And therefore, is it really an investment? Okay, yeah, it appreciates. Great, awesome. That's wonderful. And might be a better place to park money. But it first and foremost is the place where you live, right? And you don't want to play with that. And there's always, and even if you do have it paid off, there's always going to be expenses. There's tax liability, there's maintenance liabilities, upgrade liabilities. If you're going to hold it for a long period of time, people think, oh, I'll just ride the wave of value. Well, those median price indexes are based on the homes that are selling today, which are usually market ready homes. And if you stay in a home for 20 years and there's no updates, it's not going to be at the same level as the homes 20 years from now. So there's always these liabilities that you carry in your own primary residence, just like you would in any other investment. There's risks and rewards. The reward, though, with your primary residence is your life. And is that something that you want to gamble with? I don't think so. And I don't think we should be encouraging people to gamble with it. I think people should look at an entire financial picture, because when it also comes to home ownership versus renting, there could be reasons why you do want to rent. I do think home ownership's a great thing, particularly the way the real estate markets work right now with how crazy prices are going over the past 20, 30 years. It's going to be a lot easier to buy a house if you already own a house because you have that equity that's being built up. That's what I believe. But that's not the entire picture.
I look at it, Matt, too, as I know in our world, California, we've been talking about, we have rent control down in San Francisco and all kinds of stuff that they're doing to kind of try to control. And I get there's a lot of factors here that we're talking about, because a lot of the people that they're making these controls for can't go buy a house. They don't have the finances or the savings to be.
And in home ownership too, insurance is a factor too. I heard just a story. This is horrible. But the last hurricane that went through Florida, there were several homeowners those tornadoes that came through, some people lost their homes, and some of those people had their homes paid off and took their insurance away.
We had a ton of people here locally when the fires came through. We lost 1,300 homes in my town. We're going back a handful of years now. I'm looking at my window right now. I can still see the burn scar. That's how close the fire came to my house.
You're a homeowner. You have to deal with that. If you're a renter, you don't.
A lot of those people, they didn't have insurance, lost their homes, all those types of stuff. So there's these risks and these rewards that we get with being a homeowner. And there are expenses that continue to come along, but it does allow you to hopefully try to fix in some of your costs. And I think that's one of the beauties of being a homeowner, is that Sarah and I made a commitment many, many, many years ago that our house payment we're just never going to allow it to be more than a certain amount. And we've kept it there pretty much. We jumped up a little bit here a couple of years ago. We did some improvements to the house, and we're like, let's roll that into the home and, build it into the rate. And we're like, it's going to take us above that threshold that we want to be at. But for the most part, we have been able to be the ones that have been in control. And when you're not a homeowner, you're really not, you don't have that control. You're at the mercy of the world around you and what somebody else decides. And I look at, there's so much value in being a homeowner, but it can't be, and I'm going to go back to, it can't be looked at as an investment tool personally for yourself. And this is where I think the waters got muddied up here a long time ago. We started to look at this and say this saying, marry the house, date the rate, continue to push yourself up, get that house you've always wanted, dream home that you've always, always, always wanted. And I'll tell you, Matt, there's cars that are my dream cars that I don't have because I can't afford them yet. There are dream houses that are out there that I would love to live in with different views, and maybe it's on the ocean. I can't afford it yet. It doesn't mean that you bury yourself going, at some point, this little thing's going to get better here, and I'm going to be able to fix this uncomfortable situation because I'm just dating this over here, but I fell in love with this. The falling in love over time, when you are financially buried in a home, basically payment, was it house poor?
Yeah.
That saying, that's not a fun place to be in. This thing that you fell in love with, that you're like, oh my gosh, it's everything I ever wanted. You start to resent it. You pull in the driveway every day, and you see the lights on the side of the garage doors open, and that feeling of, I have my dream house is now this, I am underwater and this isn't fun. And what did we do? And as real estate agents and as trusted advisors, I'm just going to end it with this, Matt. You don't want to attach yourself to that energy. You don't want to have them making a decision based on something like that, because long-term, building great relationships, being the one that they go, we can trust what that my realtor says. I hate to say it, if I had somebody that sold me on that, made me make that decision, I would not be using that realtor again.
I 100% agree. And so my challenge to realtors is, do educate yourselves on some of the math, right? I'm constantly trying to learn more and more about all of the things at play, because every new year involves more different things in our lives and how our homes relate to that. So, but at the very basic, look at like all the factors and make it your prerogative, your mission to educate your clients too, and help them understand all the wonderful things about home ownership and also all the responsibility that comes along with it, instead of just using because I would love to hear if you used this phrase, like no shame. But I would love to hear, did you get business because you said that? I just don't even think that actually works. I don't think people all of a sudden got business because they said, hey, you know what? Marry the house, date the rate. I'm a genius. I am a total genius. And now people are like, oh my gosh, I can't believe Garrett just said that. That's like eye-opening to me. We need to go buy a house. I would love to hear if you actually got business just because of that. I'd be willing to bet that it's probably not, that didn't really happen, but
private message Matt if you are not feeling like putting that in the comments.
Yes. Well, and I will say, now that it's been over 2 years, and I think we even said like, hey, we'll see how this goes. Well, we're over 2 years from that saying becoming really popular. And I think we're seeing how it's going, which is the rates didn't come down, right? People are probably sitting in homes going like, I thought I was dating this rate and now I'm marrying this rate.
Not only did rates not go down, but cost of daily living has gone up. Insurance has gone up. Like, we talked about it. My mother and father-in-law's property, they went from $8,000 to $25,000 is what their quote went up to. They did get it down, but they ended up having to pay it all up front with this crazy deductible that they have now on this property. But you look at this and you go, those are expenses that people have been hit with while they're dating this rate. And it just starts to add up and bury and bury and bury.
And I think some people will say, well, you know what? But they got the equity. Home prices have increased over the past 2 years. And it's like, yeah, but you can't do anything with that equity. You can't go and take that because any other home that they'd move to is also more expensive. So it's like, that's not an excuse either.
What if the home didn't appreciate that? What if we didn't have appreciating prices? Like, we got so used to a handful of years, Matt, of like being able to
they haven't appreciated that much in the past 2 years, like nationwide anyway. I know certain pockets are like, man, this is great. Austin, Texas, go talk to Austin, Texas. Go talk to somebody who bought a house, marry the house, date the rate in Austin. They're not happy, right? People who bought before, they're very happy still because Austin was like.
Go look at the federal housing FHFA, go look at the HPI index in there and go to the bottom list of all the cities at the very bottom and go look at all the states at the very bottom. And those are the places that have actually seen negative appreciation over the last 12 months. And you want to find people that married the house and dated the rate and are actually stuck.
Yeah.
Stuck right now. Like, that's a reality.
I guess this is a cautionary tale.
Guys, if you like this though today, like these are the episodes I love, Matt. Like, this is kind of like, this is us just getting to blow off and have some fun here, some steam and have a good time. But share this. Like, I would love it if people, like, if you know somebody who needs to hear this, or somebody that you're like, I'm so happy we didn't go down this route, and share it with a friend, please share this episode. I'd love for you to share it.
Yeah, please share it. If you're watching it on YouTube, make sure you hit the subscribe button and the little bell icon so you get notified when we release, which happens every Monday and Thursday. And we also are starting to get some little clips out there for you on YouTube. Also on our socials, you can follow Garrett and myself on Instagram and engage with us there. And you can also check out our incredible coaching community where we actually work with agents on topics like this every single week. And we call that the 11 circle. So go to lifeat10tenths.com. You can get in there. There's a fun cheat code because it's business planning season. By the time this is released, we've finished all 3 business planning sessions. So your cheat code to go get your entire business planning for free is to just go catch our 7-day free trial. You can binge the episodes if you want. If you don't like what you see, which I think you will, you don't have to stay. But if you like what you see, you can stay with us and grow your business, because we love supporting people in their growth and seeing them thrive. Because just like owning a home is way more than just the financials behind it, running your business so that you can have a life is about your life. It's not just about hitting a certain GCI in a year. And we want to make sure that you guys are building the life of your dreams, because you can do that without the money sometimes too. So come check us out there, life@10tenths.com. We appreciate you guys. Keep tuning in. Love you guys. We'll see you on the next episode.
Thanks, everyone.